Hello, wonderful people. We shall be talking about interest rates today. We want to see how interest rate differential affects our trade. Now, what is the meaning of interest rate in Forex? We don't want to go into details about interest rate, but this is just a precise meaning of interest rate. It simply puts as money attempts to follow the currency with the highest real interest rate. That is it. Money attempts to follow the currency with the highest real interest rate. Now, the real interest rate is the nominal interest rate less inflation. And this is the most important part. Forex traders must keep an eye on each country's central bank interest rate, and more importantly, when it is expected to change to forecast moves in currency. So what it means is that when interest rates change, the direction of the forex market also changes. That is what we can deduce from this second part. When it is expected to change to forecast moves in currencies. So when you change interest rates between two pairs, it tends to affect the direction of that currency pair. So to do this, let's go to a website where we can find interest rates of different currencies. So there are two ways to access the currencies on this website. You can go to countries, and here is the G20 countries here. You can access the currency rate of each of these countries here. For example, if I go under United States and I come to interest rate, I can see that it is 5.5. Let me go back again. Let me check that of Euro area. I go to interest rate, it is 4.5. Now let's go back to the home page, which is tradingeconomics.com, and scroll down to this section where we have countries. We can click on this plus to give us more countries below, or we can just make do with what we have here. Now this is United States, and under interest rate we have 5.5 as we've seen earlier. Then let's check euro, and under interest rate we have 4.5 as we have also seen earlier. So how do we make use of this interest rate? The interest rate can tell us the direction of a pair. For example, let's start from AUD USD. So we go and check for Australian dollar. So we come over to this place and look for Australia. You can see Australia here, and if you check under the interest rate, we have 4.35. So what it means is that the interest rate for Australia is 4.35. So let's go check that of USD, United States, and here is it 5.5. 5.50. Now ask yourself, what is the difference between these two interest rates? Let's pull out a calculator and do that. 5.15 you subtract 4.35. So the difference is 1.15. So this is now the interest rate differential. You can see it's kind of small, but what we're going to deduce from this is this: The interest rate of USD is heavier than that of Australian dollar. So since the USD is heavier, this pair will tend to sell before, because USD is heavier than the Australian dollar. So what is happening on the chart now? Is AUD USD falling or selling? You can see that AUD USD is selling. So the next pair we're going to check is Great Britain USD. We have already seen that the interest rate of USD is 5.50. So let's try and check the interest rate of Great Britain. So this is a United Kingdom, and as you can see here, the interest rate is 5.25. 5.25. So what is the difference between these two? 5.50 subtract 5.25. So the difference is 0.25, which is a small difference. Although USD is heavier or has more interest rate than Great Britain. So what it means is that GDP USD is going to be selling, and this is 4-hour time frame, and you can see that GU has been selling since last week. Okay, so let's go ahead. Let's check the next pair. Great Britain Australian dollar. So let's check that as well. So we have Great Britain, and we have Australian dollar, and we can see Australian dollar is 4.35, and Great Britain, you can see here, is this 5.25. So let's compare and find the difference. So we say 5.25 subtract 4.35. That will give you 0.9. So it means that Great Britain is heavier than Australian dollar. So what we expect this pair to do is this. Since Great Britain is heavier, we expect a buy from this pair. So this is the rule. If the first is heavier, it's gonna buy, but if the second is heavier, it's gonna sell. As simple as that. This difference is just to help us find the rate, the difference. You can see the difference between the interest rate of this pair is more than that of these two pairs. So this one is gonna move, or is gonna trend more than these ones. So let's continue. Let's check the next pair, Euro USD. Let's see what is going on here. So let's check Euro. We have a USD as a 5.50. 5.50. Now let's look at Europe. So we go back. So we go back to our chart, and this is Euro area, and the interest rate is what? 4.50. So we have 4.50. So let's find the difference between these two. So we say 5.50 50 and subtract 4.50, and that is we have 1. So what it means that this pair is going to trend more than this pair. That is just the meaning. So now, since USD is heavier or greater than euro, and USD is the second is going to sell, and if you see what is going on here, euro USD is selling. Let's try GU. So this is a Great Britain here, and this is USD, and USD is 5.50, while pound is 5.25. So when we find the difference between these two, let's quickly do that. Difference is 0.2. Coming to compare both of them, USD is greater than Great Britain, so this pair is expected to sell. Let me complete it like this. And when the first one is bigger, buy. So let's look at GU. You see that GU is selling on H4. I would like us to look at Great Britain, CHF. So CHF, so this CHF stands for Swiss francs, which is the currency used in Switzerland. So let's go to our chart and look for Switzerland, and you can see that Switzerland is not within this first countries. So I'm going to click on this plus here to display all the countries. So let's go down and look for Switzerland, and here is Switzerland, and you can see the interest rate, which is 1, 2, and 3. Interest rate is the third one, if I'm not mistaken. Here is it, 1, 2, 3. So let's go down to Switzerland, and here is it. It is 1.75. 1.75. So let's find the difference between the two. The difference between the two will enable us to know how the market is trending. 5.25 subtract 1.75. Can you see that? Have 3.5. So far you can see that this pair has the highest interest rate differential. The interest rate of Great Britain is greater than the interest rate of CHF. So in this case, using our formula, the market is going to buy because the first is bigger than the second. So this is our chart now. You can see the market is buying and that. So let's try this AUD JPY. Now, most of us don't trade this pair because of the timing, but let's see what we're going to have when we check this pair. Let's start with AUD, that is Australian dollar. We have it somewhere here, which is this, and the next is the JPY, that is Japan. You can see that of Japan is negative 0.10. Now, I don't think we need more explanation here. You can see that the Australian dollar is far bigger than the Japanese yen. So what it means is that this pair is supposed to be buying. That's what it means. So let's see. So what can you deduce from here? Since 23rd of December, we've seen pair shooting to the upside. So this is a buy. So let's check New Zealand Canadian dollar. New Zealand, have we done New Zealand before? I don't think so. What about Canadian dollar? No. So NZD CAD. So go over to our chart. New Zealand. This is New Zealand, and what we have here is 5.50. 5.50, and the Canadian dollar, okay, that is it. That is 5.0. So if you find the interest rate differential, we're going to have 0.5. So we don't expect this pair to trend like this pair. So let's see what's going to happen. And the first is greater than the second. So what we need to see is that this pair is buying. So let's confirm that. Is it buying? So what you can see here is a consolidation after a buy, and this buy started from October 2023. So what we can see that the market is buying. Just recently started this consolidation. So what are we trying to deduce here? I know you are beginning to see something now, that interest rate of a currency pair can be an additional confluence while taking your trade. New Zealand USD, this is New Zealand here, and USD. Okay, let's just take the number. USD is 5.50. So what do you notice here? You want to look for the interest rate differential. It's going to be 0. So when you compare both of them, you see that they are equal. So when we have equal interest rate, what happens to that pair? New Zealand USD. So what we have here is a sell, but there's something you need to understand. These figures you see here, they are not permanent. Changes as the news is being released. For example, here is today's news. Some of these news can talk about interest rates. So when a news is released about interest rate is going to affect the currency as at that time news is being released. And that is why we say this. Forex traders must keep an eye on each country's central bank interest rate, and more importantly, when it is expected to change to forecast moves in currencies. So these interest rates, they do change, but so far from our observation, 9 out of 10 is a pass mark. Interest rate affect the direction of forex market. So whenever you want to take a trade next time, do well to visit this site, tradingeconomics.com, and compare the interest rate of the pairs you want to trade. And if the difference are bigger, it shows that pair is going to trend more than when we have a little difference between the pair. So it's as simple as that. So in order to know a trending market, you have to look for pairs with big difference in their interest. Then when we have little difference in interest rate, it could mean consolidation. So this is where I'll be ending this video. Thank you for listening, and I will see you on the next one.